Humans are plagued with systematical cognitive biases and errors. I will show you 3 major cognitive biases that need to be overcome in order to become a successful investor. This video has a potential to change the way you are thinking. The errors we will discuss today are highly relevant, scientifically grounded, and must be overcome. Hello and welcome to Finance with Axel. That's me. Today I want to make you a better investor by showing you 3 thinking errors everyone makes, which are irrational and hurt your returns a lot. Keep in mind that I am not a financial advisor. I am just a guy producing high quality finance and crypto content. I don't know if this effect has a scientific name. Maybe I am the one having discovered it. Anyways, people are way too irrational. I will use crypto terms in order to get to the bottom of this effect. FOMO, the fear of missing out, and FUD, also known as fear, uncertainty, and doubt, are omnipresent in the markets. Usually it's heavily screwed in one direction. In the bear market, FUD is overwhelming. In the bull market, people are FOMOing in. These tendencies also exist in financial markets, but are most noticeably in less mature markets such as crypto. I believe this is the case because stock trading is much more professionalized and crypto is currently still mainly driven by retail investors. People behave so blatantly irrationally that I am simply at a loss of words. Most of the top 100 cryptocurrencies are down 60 to 95%. If there were such discounts in retail stores, people would fight over these deals and buy up everything in no time. The opposite happens on the capital and crypto markets though. After major declines, no one is interested in investing anymore and only a few buy the dip. The rational thing to do would be to buy Bitcoin now as it is available for 20,000 instead of 60,000. Instead, the same investor who absolutely had to get in at 60k now comes to the conclusion that Bitcoin is too expensive. It seems that people don't understand that when everyone is talking about some hot investment and it's all over the media, they have missed the right entry point. Unfortunately, in this case, often the FOMO dominates rational thinking and they can't resist to buy at the top or close to it. While after heavy sell-offs, FUD prevails and hardly anyone has the balls to buy in. I always get very excited and do most research in the bear market in the hope of finding bargains. This is also the correct approach. After all, who doesn't like to buy with a big discount? You just have to keep your inner coward in check with rational arguments in such times. The real tragedy is when the people who previously bought at the top are now so devastated by FUD that they manage to get out at the bottom or close to it. Buy high, sell low. Wait, this should be the other way around. Moving on. The so-called overconfidence bias is a major issue most people have. Almost everyone systematically overrates his abilities and knowledge, often to a degree that you are the only smart one and all others have no clue. There is no other way to explain why so many people continue to rely on active investing without diversification. Often people risk all their wealth by betting on only one or a few assets, often with catastrophic consequences. Diversifying worldwide with low-cost index funds and ETFs might be boring, but it is the most promising strategy if you want to build wealth over the long run. Related to that, many people just want to take shortcuts, hoping for a lottery-like win. This is possible, but not very likely. Anyways, keep in mind that for every big lottery winner, there are many other gamblers who lost a lot. The best way to build wealth is steady and slow with realistic profit expectations. I made videos on the best strategy for the stock market, explaining everything in detail already. If you are not familiar with the buy and hold passive investing approach yet, feel free to check it out. I also put different investment products to the test. If you want to know which are recommended and which are rip-offs, click somewhere here. The disposition effect is another major bias that should be avoided. This effect is an anomaly discovered in behavioral finance. It describes the tendency of investors to hold on to assets that have dropped in value and to sell winners too fast. The disposition effect is not a rational sort of conduct. This tendency probably exists because of the loss aversion inherent in all, or at least most of us. Meaning that losing $1 hurts more than winning $1 gives you pleasure. That's why losers are kept, as people don't book this loss until they sold the position. Irrationally, many people do not consider the loss to be incurred until the shares have been sold. If they continue to hold them in the hope that the value will recover at some point, they do not yet have to face the reality that the money is lost. Of course, this is another mistake because whether the loss is realized or not is completely irrelevant. This investment behavior is a product of humans trying to seek pride and avoid regret. Have you noticed one or more of these biases in yourself? Let me know. If so, it's time to get rid of this behavior. Please share this video with someone who might also benefit from this content. Also, don't forget to like and subscribe. Thanks for watching. Until next time, bye bye.